Hey everyone, and welcome back to another potential multi-bagger video. We've done a couple of those this year, so here's another one. This is a company worth $2.25 billion. Now, yes, it is a company that has seen its valuation go up by 211% year to date. The company that we're talking about here is Pagaya Technologies. Yes, it is another fintech name. Now, in this video, I'll explain everything the company does, what it doesn't do, how it continues to grow, why this is a tremendous business, even after the stock going up 211% year to date. So without further ado, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. Okay, so let's start from the beginning. So Pagaya's primary role is to fund loans for its partners, who are banks and fintech companies like a SoFi, for example. Actually, if we go back a couple of years ago, back in 2021, Pagaya partners with SoFi to expand access to financial services and create opportunities for customers. Here's a quote by Anthony Noto back then. "We're excited to leverage SoFi's sophisticated tech platform, strong brand, and consumer appeal to originate loans through Pagaya's AI network, extending its business to a broader audience, so more people can access credit and achieve their financial goals." And so, what does Pagaya not do? They're not a direct lender and they do not primarily use their own bank balance sheet to fund the loans. They're not a bank. What they do is this. They raise massive amounts of capital from over 145 large institutional investors like pension funds and insurance companies. They package this capital into complex financial products called asset-backed securities, or ABS. This capital is then used to fund the loans originated by their partner banks. The benefit from this is as follows. This solves the bank's liquidity problem. It gives the banks a source of non-stop high-volume funding so they can keep lending money without running out of cash. Of course, we've talked about SoFi's loan platform business in the past and the switch that they've been making over the past year and a half or so. So a bit similar, right? Now, Pagaya is a, let's call it, AI company whose AI models determine which borrowers get approved for a loan. Of course, yes, this is not a new thing, but if you start approving bad people, people with high chance of delinquencies, your business model goes down the drain. Now, the AI's job is this. Pagaya's sophisticated AI looks at far more data points than traditional credit scores. It is designed to reliably assess the risk of borrowers, particularly those in the middle to lower income brackets that the partner banks would normally reject. Now, you might say, middle to lower income brackets, higher risk. Well, as I will show you in a bit, you will see that Pagaya is actually extremely selective. Only about 1% of all loans applications that pass through the network are approved by Pagaya's AI. This extreme selectivity is why the institutional investors trust the process. We've seen that also with SoFi, right? The loan platform business. They've rejected, they said, over $100 billion. Well, a bit of the same here. Extreme selectivity. Now, the benefit from all of this is, of course, it solves the bank's risk problem. It allows their partners to safely access a broader customer base they couldn't serve before, effectively expanding their addressable market. Now, the income stream here is quite simple, a fee from facilitating the transaction. They charge a percentage fee on the total amount of capital they intermediate, basically the fuel here. This is a reliable recurring revenue stream. Now, why do they hold some of the loans? Due to regulations. So Pagaya must hold a small portion of the loans, typically around 3%, they underwrite on their balance sheet. This is a critical point, of course. Why? Because it does align the interest, right? If the loan goes bad, Pagaya takes the first hit, most concentrated losses. And of course, if they think the loan is good enough for them, then it's going to be good enough for their customers, their partners, which of course forces them to continuously improve their AI models to keep defaults low, ensuring their core fee-based business remains highly profitable. Quite easy to understand. Now, if we go back to look at the last quarter's results, we see the following thing. This is a fast-growing business. Not only that, it's a business that becomes more profitable as well. So network volume did increase by 14%, yet total revenue and other income increased double that, 30% year over year. Not only that, we are seeing here revenue from fees less production costs also increasing 30%. And what we're also seeing is that core operating expenses were down 12% year over year. So they are managing to monetize their business more and more while also reducing operating expenses. Now, this is what has happened with Pagaya's revenue over the last couple of years and what's expected in the coming years. For fiscal 25, revenue is expected to grow around 27% year over year, and then we see 2 consecutive declining years. So only 16% growth year over year for 26 and then 12% for 2027. I do think that these numbers are quite conservative. But remember, this is a company worth $2.2 billion, expected to generate $1.3 billion in fiscal 25. If we look at free cash flow margin, gross profit margin, and revenue growth, we can see that one, free cash flow margin has improved. In 24, that was 4.7%. In 25, that's 10% so far in the last 12 months. Gross profit margin is around 42% or so. Yes, it's down a little bit from 2021, but revenue did increase much faster than gross profit. What's also impressive here is that operating margin is now at 14.1%. Look at that huge recovery over the last 12 months, that is, but since Q2, Q1 2023. Then if we look at the evolutions of the fees less the production cost, we can see the following thing. The gray line right here is fee revenue as a percent of network revenue. Then the dark blue line is production cost as a percent of network revenue. And then the fee less production cost is this blue line right here. They are targeting between 4 to 5% in 2025. And last quarter, they were already at 4.8%. What we can also see here is that Pagaya is getting better at monetizing its network, and they're also keeping more money for every dollar of loan volume it processes. Of course, in an ideal scenario, you would like to see the dark blue line go down as well. But as long as the first line right here, the gray one, fee revenue as a percent of network volume grows faster than the production cost, we are good. We've also seen that lending partner products as a percent of total fee less production cost is increasing. We're now at 81% compared to let's call it, compared to just 1% 3 years ago. Of course, the bigger this number, the better. Then going back to the point we've mentioned at the start. So we have here $238 billion application evaluated in Q2 2025. Only 1% conversion rate. So the massive scale on the front end and the surgical precision and discipline on the back end is what makes it actually quite a compelling investment, right? Because if, let's say, the conversion rate was at 20% or so, but then the profitability goes down the drain, then what's the point? Right now, this is impressive growth. This, of course, stays at 1% or so. Maybe it can go to 2% over time, but right now, 1% conversion rate. Yet, what we've seen from the company is total revenue increased 30%, revenue from fees less production costs increased 30%, core operating expenses down 12%. And so yes, right now, Pagaya is getting better at monetizing its network, and they're also keeping more money from every dollar of loan volume it processes. And so as long as this line right here, as long as this number right here, $238 billion, goes up every single quarter, every single year, and Pagaya manages to monetize its network better, they manage to keep more dollars as well, this is going to be quite a profitable business. Now let me talk a little bit more about the business and the potential for the future. So Pagaya uses a business to consumer model. They aren't trying to market to consumers, they integrate their AI directly into the existing digital application platforms of their partners, the banks and the fintechs. Again, an example, SoFi. The initial value proposition is for the lender to pass applicants they would normally decline through Pagaya's AI. This allows the lender to approve more customers and protect their existing customer relationship, effectively increasing the lifetime value of their customer base without taking on credit risk. Once Pagaya is integrated, it gets access to constant flow of new data. This vast, ever-growing dataset continuously trains and improves their AI models, making their underwriting superior. This continuous improvement makes the AI's prediction more accurate and reliable, which makes this service harder for partners to replicate, a powerful network effect. Now, the power of operation leverage that they have right here. So they're trying to reach a target of $25 billion in network volume. They can't solely rely on personal loans. So their strategy is to apply its core AI engine across the entire consumer credit market. They are rapidly expanding into new areas like auto lending and point of sale financing like buy now, pay later, which now represents a significant portion of the network volume. They've also touched on single family rentals and credit cards. For existing partners, of course, Pagaya isn't just a platform for rejected applications anymore. They are introducing new products like a direct marketing engine to help partners grow their application funnel, further leveraging Pagaya's funding and underwriting capabilities to serve existing customers. This deepens the partner relationship and provides new growth avenues for Pagaya. And then lastly, de-risk funding and capital efficiency. So Pagaya is systematically reducing the amount of credit risk they are required to hold by securing high ratings like AAA on their asset-backed securities and using more capital-efficient structures like forward flow agreements. They minimize the regulatory need to retain exposure. The goal is to reduce their balance sheet retention to a very low single-digit percentage point, ensuring the business remains primarily fee-driven and insulated from large credit losses. Fee-driven, high-margin, low-risk business. Again, we've heard that before. SoFi's loan platform business. Lastly here, with over 145 institutional investors, more to come of course, they have a highly diversified and stable base by fuel suppliers. Of course, it's all the data that comes in, all the loans that might come in as well. This massive capital network helps them remain resilient across different economic cycles, ensuring that when their lending partners are ready to grow, the funding is available. Last quarter, they also told us that demand for new partner addition remains robust, particularly from US regional banks and leading fintechs. Pagaya is in late-stage discussions and onboarding phases with several new partners, including a top 20 US bank for personal loans and large US private banks for point-of-sale financing, signaling continued expansion across asset classes and partner types. The company views itself as a category leader in creating a syndication market for consumer credit, emphasizing its unique, hard-coded tech stack and diversified funding network as key competitive differentiators. Now, I know what you might ask, yeah, but after the recent Upstart comments, isn't Pagaya here at risk as well? Well, we actually have one analyst note here that came out just after the price went down. Buy rating and a price target of $48. While investors shouldn't assume Pagaya is experiencing credit deterioration attributed to Upstart, starting with much stricter credit box and different business model. If you want to read all of it, I leave this right now on the screen so you can pause it and read it all. But I will touch on this point right here. To understand the contract, it may help to outline Upstart's business model. Upstart is an originator platform. It partners with banks to originate loans and then seeks to sell those loans into capital markets or to institutional buyers. When liquidity tightens, Upstart often has little choice but to retain more loans on its own balance sheet. That creates direct exposure to credit losses, meaning that its operating results are highly sensitive to delinquency trends. And so lastly, this is where we are. On the weekly, we can see that the stock did go above the 200-day moving average in this case, but it did drop since then 33.8%. If we go and look at the daily real quick, of course, it's still down 33%. It's under the 50-day moving average here and just over the 100-day one. But it has seen previous support around these areas, especially if we go all the way back here to July 2023. It was, well, close to resistance back then. Could it be support right now? Maybe, maybe not. But the value, of course, is in the long-term potential of this business. Is this pullback right here an opportunity to buy in for those that are extremely interested in that business and didn't want to buy when it went up and up and up and up? I do think it is. $2.2 billion. Yes, another fintech player. But again, it's a fintech player that it's growing, expected to grow way more in the future, and it's also becoming more and more profitable. Could it become an acquisition target? I think it could. So that's about it. That's the other Multibagger episode for you right now. If you enjoy this type of videos, hit all the buttons and we'll see each other in the next one. Bye-bye.